Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for November 14th of 2023. Well, the charts are coming to you a couple of days late this week. I had some things going on over the weekend, was not able to get to it. And interestingly enough, I was going to start off with some inflation expectations. I'm going to visit a little bit more about that in my market minutes, but inflation data came in better than expected, and the all-in CPI, Consumer Price Index, was up 3.2%. Core was up 4%, so the data continues to trend lower, although it is relatively sticky. But anyway, defer those comments, and I pulled those charts out. Market was looking for something, meaningfully higher than what came in today. So, just to sum on the inflation front, data was better than expected, still trending in the right way. We'll continue to monitor it. But what we have here is some economic growth projections, as well as inflation projections, and these are apt to be modified perhaps a little bit. This comes to us by way of Morningstar. You can see in the upper part, those are the GDP forecast revisions. And if you look at the far left there in 2023, it is interesting to note here that back in the summer, we were looking for fairly muted growth. I mean, the outlook was not terribly great. We know that we saw a fair amount of disruption in the investment markets during that period of time. And so since then, the feeling is that we're closer to the end of the rate tightening cycle. In fact, I think the feeling is very much so that we're at the end of rate hikes now. And you can see that that the current forecast now is for 2.3% growth in 2023. Similarly, down on the bottom, you can see, inflation forecast around 3.6. That's relatively unchanged from July, and perhaps in August it came down quite a bit. Now, I think one of the key takeaways here is that 2024 GDP is now looking, to be somewhat soft. This is very consistent with the conventional wisdom, very consistent with kind of how I see things. With the world kind of slowing down just a little bit, not necessarily going into recession. That probability is exceptionally low right now. But if you look into 2025 and 26 and 27, you're in the throes of a new economic cycle, and you can see inflation down on the bottom. Once it peaks here in 2023, it's expected to stay lower, which will, if this comes to fruition, you'll see lower interest rates and growth, and then obviously that will be good for equities and valuations and multiple expansion, so on and so forth. Now we want to kind of offer up a little bit of sobering news on a couple of fronts, and I think this is something that bears watching. Something you always watch for in a downturn is credit erosion, and in this case, credit balances. People, you see incomes still remaining pretty high, but they're coming off their peaks. But you see credit card balances year over year moving up about 16, 17%. You can see here. You can see the rate of acceleration from nary 2 years ago, but that number is definitely moving higher, and we want to continue to keep a close eye on where overall credit goes, because it serves as a barometer on the future health of the consumer. So we talk about credit card balances. You can see the delinquency is trending higher. See that trough a couple of years ago, about a year and a half ago. Now we're up to about 8%. So it brings us back to levels that we saw in the kind of the early part of the last decade, following the global financial crisis. So delinquencies moving higher on credit cards. Now I take the credit cards and I overlay that with auto loans. And so this kind of gives you a much broader sense of where the credit quality lays right now. So you think about autos and credit cards, and that accounts for a huge chunk of an average consumer's monthly obligation. And you can see both of those trending in the same direction. As we stay with the current profile, looking at auto payments, you see here that percent of borrowers at least 60 days late on their car loans is at the highest point on record on a data series that goes back to 1994. You can see the transition over a period of time. You can see where we were actually moving up during the last decade prior to the pandemic. And so, if you kind of back out that dislocation, we're at or absolutely above those peak levels that we saw throughout that last decade. One thing we've been watching for quite some time is used car prices. You can see this index is now at the lowest point since March of 2021. And, when it was at its peak, it was certainly influential on the overall inflation picture. This is I would say at best modestly disinflationary at this point. Affordability is still a little bit higher than, or excuse me, a little bit more challenging than it was prior to the pandemic, but at least is trending in the right direction. So anytime you have a conversation about future potential slowdown in the economy, the first thing you want to think about is the health of the consumer and the ability to spend. What's their purchasing power? What's their inclination to spend? Are they afraid? What are the sentiment factors? And that all kind of fits into the self-fulfilling prophecy that oftentimes you see. When you talk about a downturn enough, it actually materializes because your sentiments manifest into behavior. And so as we look at this chart here from Game of Trades, you can see net saving as a percent of gross national income, which is kind of the opposite side from gross national product, or GDP, gross domestic product. You can see here that with the gray bars overlaid, these represent recessions going back to World War II. And net saving as a percent of national income has actually trended down for quite a while. And back in the global financial crisis, it actually went negative. And you never want to see negative savings rates. But however, what's interesting right now is that we've seen savings come down quite a bit in just a relatively short period of time. And so it's kind of a harbinger for slower overall consumption and slower overall consumer activity. And considering the consumer does represent about 2/3 to 70% of the total economy, this fits very much in line with this narrative about the economy slowing and slower overall economic growth next year. Well, as we continue this narrative about the consumer and the prospects for a slowdown in consumer spending, consumption, et cetera, for every slide that kind of leads you down that path of believing that we're going to have that consumer slowdown, you see a chart like this, consumers planning to go on vacation to a foreign country. And we've got a couple of slides that follow that kind of corroborate this whole theme here that consumers may be running out of gas at some point, but they certainly don't see it. Now, there's a lot of people at the lower income cohorts that have been belly aching over higher gas prices, higher energy costs, utilities, so on and so forth. And even though they're now getting a relief in gasoline prices, there's still other things in their basket that they're belly aching about. But at the upper income cohorts, you see something like this, where people are pretty cavalier and very motivated to want to take trips. This is something else that I saw in Charlie Bilello's pack of the week, and it kind of stunning. Again, the last slide talked about people are going overseas, wanting to spend a lot of money. This time, on this slide, we've got Taylor Swift tickets that are starting at $1,500 for a concert in Miami that doesn't even happen for 11 months. This is outrageous. But this is the backdrop that we're dealing with right now. We'll switch gears and talk about the housing sector for just a second. I know I seem to talk about it quite a bit, but a lot of moving parts here. In this particular chart from Game of Trades, we've got median home prices are moving the opposite way. Now, we did see a little bit of support there earlier this year after having those prices kind of roll over, but right now we've got affordability problems. Mortgage rates, even though they're not at their peak, they're still pretty high, and the market still hasn't fully adjusted to that higher tier of mortgage rates. And obviously, with prices high, there's a very high disincentive for people that own their homes unless they're inclined to want to downsize, et cetera, that they're just not moving. So the supply's off. You've got home prices that are now in contraction, and obviously this is something that does feed in kind of in a lateral sense into overall economic growth. And to it, here's a chart that kind of shows you the rapid divergence in sentiment. Consumers that think that, frankly, it's a bad time to be buying a home, and that's not too surprising with mortgage rates moving higher, everything we've talked about. People not selling their homes, prices high, even though they're kind of falling off their peak right now. But sentiment is pretty negative in the housing sector, and we still have new home builds that are moving along. You still see a lot of builders that are buying down their rates with incentives to get people to move in. And so, yeah, I want to caution that not all elements of the real estate market are bad. Sentiment, though, is actually pretty weak at the moment. Here we have Brent crude. Good news here is that we've seen a rolling over in those prices. This is translating into distillates, i.e. gasoline. Gasoline prices are certainly off their peak and hopefully apt to give consumers some relief heading into the holiday season and the end of the year. And, it shouldn't be understated that gasoline prices, to some extent, fuel sentiment, and sentiment fuels, spending. And we are really on the cusp of the 2023 holiday shopping season. And so, I don't want to like oversell this necessarily, but a rolling over in gasoline prices that is a byproduct of crude prices falling, which you see in this chart, is actually helpful to the overall economic picture. If you're hopeful that consumer spending heading into the end of the year is going to be relatively strong. Here we have the average retail price of gasoline. As I was just alluding to in the prior slide, this kind of takes Brent crude and kind of breaks it down into at least one of the many distillates that you get from cracking crude oil. Now, again, I think this is positive for the economy. It's potentially positive from a sentiment and spending standpoint. It is volatile. So just so looking back at 2022, prices came down quite a bit towards the end of the year, and then they went back up, and obviously peak driving seasons tend to have a muted impact on prices. But just know that gasoline prices, even though they're coming down in a fairly pronounced way, they can still be pretty volatile over time. Here we have some information on banking, and I'm very interested to monitor this. I'm very interested to talk to my friends that are in the banking sector right now. This is national data, and I've become a new, really big fan of Game of Trades. They do some great work. So, on the left-hand side in the red line, you've got lending standards that are really moving higher. And so they break it down into economic cycles, and you see the gray bars for recession. And so their argument is that the tightening in lending standards, as evidenced by the senior loan officer survey and the Federal Reserve data, seems to indicate, at best, a slowdown in the economy, which, again, is very consistent with what we've expected. And I think, by all considerations here, data like this that seems to corroborate the overall consensus about an economic slowdown is actually good. You can have a functioning investment market in that environment where there are no surprises. This data kind of foreshadows slower economic growth. But, the thing is, if you look at these prior peaks that have extended beyond this dotted line here for recessionary levels, the big question right now is, if interest rates are too high, are they going to remain too high for longer? And are we going to be slipping into recession? There's a big tug of war for that right now. But we know that if credit is tightening at the banking level, you can see that on the right-hand side, bank credit is contracting in a pretty big way. So this is a function both of supply and demand. You have lower demand for loans, And on the left-hand side, you obviously have less supply. Banks are less willing to lend. This is a primary indicator of economic slowdown right here. All right, so another chart on business borrowing, and I have a chart that comes with it with regard to consumer loans. So this is looking at banking both from a commercial and a consumer side. On the left-hand side, you have C&I loans, which are commercial and industrial loans, kind of flatlining here. They did pick up after that dislocation post-pandemic, but they've flatlined right now. And so we know from the prior slide that that credit is tightening. On the right-hand side, you've got consumer side. Consumers came out of the pandemic in really good shape, strong balance sheets, home price appreciation, so on and so forth. But as we saw very early on in the chart pack this week, we've had a noticeable rise in the use of credit, whether it be credit cards, which is depicted in this line, and well above the baseline, and then you've got delinquencies that are following it. Here we have credit card balances, available credit and balance. You see not only are balances moving higher, but available credit's moving higher. So you've got people that are getting cards and not necessarily charging on them yet, but they're allowing themselves to increase their credit reserve. And then you can see commercial bank interest on credit card balances moving a lot higher. So this is the real bugaboo, I think, in the consumer credit sector, is the fact that these credit cards have inherently adjustable rates. And and obviously credit card rates are generally high to begin with. But if you're assuming that now you've got like a 21% annual percentage rate payment on your credit cards, and you've got consumers that are ratcheting up balances on those credit cards, that's a pretty profound statement. And there's a pretty poignant article in the Wall Street Journal that these charts came from, kind of talking about that issue right now. So it's a double whammy. So, card balances moving higher, overall indebtedness moving higher, but the cost of that credit is also moving higher, which again is that double whammy. Here we have small business, and same deal here. We've got interest rates moving higher on small business loans. And in a lot of cases, small businesses have like lines of credit, or they've got their indebtedness on plant, property, and equipment that needs to be rolled over. Maybe it's a term loan that heretofore has been easy to roll over. Credit's been easy, and so when they get to the end of a term, they just refinance it and essentially roll that debt over. Well, the paradigm has certainly changed. So you can see here very clearly that the interest rate regime is a lot higher. And so if you go back in time, we're back at the pre-global financial crisis levels, and actually, close to the levels that we saw, back before the tech bubble. And so the levels themselves are not necessarily as meaningful as the magnitude of the direction here. And so I just offer this to say that there's some businesses, particularly in the real estate sector, that might actually have a hard time rolling over their debt and might be in a credit pinch. So another thing that we're watching is the impact of higher interest rates on capital spending. And so most companies use leverage to make capital expenditures, to expand capacity, and you typically do that in anticipation of stronger economic growth ahead. Where you want to plan for growth for your business. And oddly enough, we sit here at a time where the economy is actually fairly strong, although clearly we see elements of slowdown. But the greater issue for companies right now is the cost of capital moving higher, and so that's having an adverse impact on capital spending intentions, which is really evidenced in this chart. And so this is some research from Goldman Sachs. Spent a lot of time with this. So higher interest expense from obviously higher rates will reduce capital spending by about a tenth of a percentage point, about a quarter of a percentage point over the next 2 years, respectively. And I think this particular analysis is pretty interesting because, as we saw earlier on the forecast for economic growth, that we get through 2024, which is kind of going to be that lull in between the two, in between, maybe this waning moments of the current economic expansion and then that next one. But as this chart clearly indicates, that capital spending is probably going to lag the beginning of the next economic cycle by at least a year or two. So now I'm going to turn my attention to the investment markets, particularly stocks, bonds and portfolio construction and historical backdrop and just additional perspective given the fluid environment that we're in right now. And so this information, again, from Charlie Bilello, shows you the percent of positive total returns if you look over, various periods of time. And this is monthly data going back to 1976. So we have a lot of data here. It's a very robust data set. And so, if you look at any one 3-month period, you have a 74% chance of positive total return. So 3 out of 4, chances to get a positive return all the way back to 1976 over any 3-month period. And so, again, last year kind of sets, puts a bad taste in your mouth because of the magnitude of the drop, particularly on fixed income last year. And but just know that over time that is not a regular occurrence. Now, 3 months is a pretty short period of time, and so obviously if you have a correction or some type of a sell-off in the market, that can create an opportunity for a negative total return. But again, if you take 3 months, you go to 1 year, it goes to 85% probability of positive returns. Over 3 years, 92, and essentially if you go 10 years, if you have the perseverance to stay in a 60% stock, 40% bond portfolio over 10 years, you have a 100% chance of having a positive return. And so, even when we talk about like structured notes that we're doing and we price some of those over, 2 to 3 years, I mean, the probability of positive total returns is exceptionally high. And I just want to draw your attention back to this to say longer term portfolios and longer term investment horizons, if you have the diligence to not let bias and emotion kick in, that are very high probability of success there. Here we have a chart with the 12-month forward PE, price to earnings ratio for the S&P 500. And this is actually, going back on a 10-year average. And so as you can see here, it does oscillate back and forth. You've got 2 dotted lines there. You have the green is the 5-year average forward 12-month price to earnings ratio, and the blue dotted line is a 10-year. So you can see here that we are currently above, we're more richly valued to a very slight degree over the 10-year average, but we are below the average 5-year forward month price to earnings ratio. So again, to this whole notion of is the market overvalued or not, as we sit here today, I would argue no. Is it attractive from a valuation standpoint? No. But it's not overly valued. Now, the big question here is what happens to the E. And so obviously this is a math problem. So you take price and you divide it by earnings and you get to this PE ratio, which right now we're about 18 times earnings. But if earnings drop, get lower, then that multiple inherently goes up. And so that I think is a risk, because I think we've seen over consecutive quarters now where we've started out like well ahead of the earnings season with higher expectations, and those expectations have come down as you get into the earnings season, and that's no different now as we've kind of like basically concluded the third quarter earnings season, and you're already seeing the fourth quarter earnings expectations, which we'll begin to get at the, about the second week of January. We've already seen those begin to come down a little bit. So every once in a while, I'll pick out a sector or two and kind of offer some perspective. And this one I came across in the chart pack last week. And it represents the U.S. financial sector, and this is a chart of the long to short ratio. Again, if you are long, you own the stock. If you're short, you have borrowed the stock and sold it, expecting that stock to go down in price so you can buy it back and then replace your loan. And so, when this number is high, when this chart is high, as it was back in January of 2021 at 3.8, which is a ratio of the number of long, the percentage of long holdings to the percentage of stock short holdings. When that number is high, that means that people are really bullish on the sector. And when it's low, as it is now, people are pretty bearish on the sector, and they're not very constructive. And that's exactly where we are with the financial sector right now. I like to spend a little bit of time offering some perspective on returns on various indices here, which you can see quite a few. And I really want to make the point here that you can have recency bias kick in. That's where you're looking at all the data that's happened like relatively recently. You tend to forget quickly what happened in the past, and so there's a lot of people that are regretful that they don't have returns that look like the NASDAQ 100 or the Russell 1000 here, or the S&P 100, which is the largest stocks, and the S&P 500 itself up 16%. But this is all concentrated in like 5 stocks, really 7 stocks if you want to get technical about it, but really 5 stocks that dominate the market, and everything else is down. Now, you can get real excited about what happened this year. If the NASDAQ 100, you're up 42.7 if you had the foresight to time the market and bottom ticket, which most people did not. But if you look at this, 2023 year to date, you see a lot of blue on the left-hand side for these tech-oriented, these 5 stocks that have just rocket shipped north. But just take note that in 2022, those were the ones that took it on the chin. So you look at the NASDAQ 100, it was down 33%. It may be up 42% this year, but it was down 32% last year. Again, for the Russell 1000, you can enjoy those returns this year, but you were down 29% last year. And the S&P 500, well, you may feel good about 16.5%, but you were down 18% last year. And that kind of volatility can drive people nuts. So I think it's important to know that you've got to take this over a long term. And if you get all excited and gloat over short-term performance, you're apt to see the reversal of it the next year if you're not paying attention. So no analysis of the market would be complete this year without looking at these high-flying tech stocks. Now, if you want to call it the Magnificent Seven or the Enormous Eight, honestly, there's probably 5 of these that are really most important. We'll start with NVIDIA. No question, great year, but the stock was down 50% last year. Microsoft down 28%. You can see all across the board, these stocks really took it on the chin last year. And for portfolios that were heavy in technology, it was a tough sled. Now, this year you're getting a lot of that back, but just know the mathematics of this. If you have a portfolio that is, you're at 100, just say at an artificial price of 100, and it goes down 50%, which is what NVIDIA did last year. You need a 100% return just to get back to even where you were the next year, to get back to a 0 2-year return. And so NVIDIA has obviously done more than that, as well as Meta, or Facebook as it's otherwise known. But some of these other stocks have not done as well in that regard. And so the recency bias here is that, these stocks have done well this year, but people tend to forget how volatile they were in a market that was historically volatile overall. Here we have estimates, upgrade and downgrades. I mentioned this a little bit earlier. You've got, heading into the earnings season, which obviously happens every 3 months. You have, either earnings upgrades or downgrades based on the sentiment out there on the part of analysts and their feeling about what company prospects are going to look like. Clearly, we've seen a downgrade, more downgrades than upgrades on estimates, and a feeling that overall growth is not going to be as robust. Good news here, maybe a silver lining, is that the downgrades are not nearly as prominent here in the last few readings as they have been earlier this fall. Here we have by sector the earnings tracking. You can see here, based on these lowered earnings estimates, you can see in the amber part here represents sales estimates. The blue represents margin, and you can see those individual margin percentages off on the side here. And so where you've seen the most benefit this year is in consumer discretionary, which is, again, odd if you feel like we're going into an economic slowdown. So you're seeing kind of like peak performance almost out of consumer discretionary. But again, keep in mind too that the expectations bar was set relatively low. So you see financials outperformed, revision to consensus moving a little bit higher, and same for tech to some degree. And you can see here on the chart those that have beat their reduced estimates. And where we've really seen some trouble is on the utility side, which is not atypical when you have higher interest rates. Certainly sales are down. And then healthcare has been a real problem child as of late. Here we have investor risk appetite, and we've had a little bit of an updraft in the market, even though it's been a little bit volatile. We've had some notable weak days, but we've had some notable strong days, including today in the market when we had the consumer price index data that came in, honestly, much better than expected. So you have now this feeling that the risk appetite is moving higher over the next 30 days. This will probably translate into a relatively reasonably good market because when risk is on, people want to buy stocks. And then you can see the expectations on the right-hand side on expected U.S. market performance. Now, again, this can change on a dime, but at least as it sits here today, people are pretty optimistic heading into the home stretch here of 2023. We talked about this a little earlier. The banking sector is in the doldrums right now, and you can see bank stocks are at a record low to the S&P 500. I think the takeaway here personally is, there needs to be some washing out, and I think if we have credit stress, and you already saw earlier where banks are pulling in, they're not lending, they're being very conservative, and even that may not save some banks. Because if you assume that interest rates are going to remain higher for longer, you do have quite a few regional banks that bet the wrong way or didn't take into account the magnitude of rate increases, and their balance sheets are out of whack, and they may become insolvent at some point. But that's rationalizing the sector, which probably needs to be rationalized. We have over 4,000 banks in this country, which if you look in comparison with any other developed market, I mean, it's an outstanding number of banks. And so we lose a few, others get consolidated. That's a good thing. Eventually, this sector is going to be really, really attractive. Something else that we're spending a little bit of time with is a relative valuation differential between U.S. markets and emerging markets. And so we spend a lot of time talking about international overall, and international markets are much more attractively valued than the U.S. market is right now. But we know developed markets like Germany, Europe, exhibiting a little bit of stress right now in terms of the economic growth. very consistent with, kind of the slowing that we're seeing at the margin at the U.S., but maybe a little bit farther along. Now, emerging markets tend to have a much lower valuation, and emerging markets, to a large degree, have been challenged in the sense that we've had a really strong dollar as of late, and higher interest rates put pressure on emerging market central banks to kind of keep pace to prevent their currencies from devaluing, and so on and so forth. There's a lot of dynamics there, but what this chart from B of A shows you is that the valuation differential is at a point that we haven't seen since 1971. And so the long and short of this is that emerging markets are at very attractive values, and it almost at levels that just beg you to take a position, knowing that there may not be a catalyst for that value to be realized for some time, but you want to be there because the valuation differential is so attractive. So we just talked a little bit about China, kind of its influence on the emerging markets, even though I would probably argue that China is not an emerging market anymore. Something about being the second largest economy in the world that probably elevates them from that status, but be that as it may, China is clearly facing headwinds, and as I alluded to in the prior slide, real estate sector is in an absolute mess. They have issued a lot of speculative loans, a lot of loans that have gone bad. The state has now said that they're basically not going to be reporting delinquent loans, and you're just not going to hear about banks folding up because they've become insolvent. You're just not going to hear about that. But it is an adverse economic situation in China. Just leave it at that way. So this chart is reflective of inflation, both at the consumer and the commercial sector. And you can see in both cases, we're witnessing outright kind of deflation right now. And so, consumer prices have been kind of flatlined for a while. They kind of perked up, and now they're back negative slightly again. Producer prices have been negative for some time. This doesn't bode well for interim growth in China. And so, this is something that, China has been an engine of growth that has contributed to global GDP in decades past, but it's not likely to be the case here over the coming couple of years. The last slide in the chart pack today is our Social Security Trust Fund balance. This is out of an article from the Wall Street Journal I thought was interesting. We've been talking about the trust fund exhausting itself for many years now, and I'm not going to, kind of like whine Pollyanna here that, it always seems to work out. And every time we thought the trust fund was going to run out, well, now it's extended a few more years. But this is just the latest iteration of this. 2035 is kind of like a fume, the fume point here where it runs out. And again, entitlements are going to be something that we are going to have to address. We can't avoid it. It's a huge part of the federal budget, between that and healthcare. But I think we're going to see an adjustment in the age for the younger generation. It's not going away, but you're going to see an adjustment in age because people are living longer, and that's putting additional stress on this trust fund balance. Too, is that annuity is continuing for a longer period of time. So clearly some changes, some tweaks are on the horizon, but it is, one of those three rails of the administration that you just don't want to touch, but it will have to be addressed at some point. That will do it for the chart pack this week. Hope you've enjoyed it. Have a great week. We'll talk to you again soon.